Hey Raj, before we even talk about numbers, let's start with something important. Tax planning in Canada isn't about shortcuts, it's about understanding how money flows.
Honestly, I thought tax was just filing forms. What do you mean by planning?
Good question. Tax planning means understanding how your business structure, like sole proprietorship, partnership, or corporation, affects your taxes.
So just choosing the right structure can change my taxes?
Exactly. And Canada tries to balance things through something called integration, meaning total tax should be similar, but timing and strategy make a big difference.
Okay, let's say I start small. How am I taxed as a beginner?
If you're a sole proprietor or in a partnership, your business doesn't pay tax separately.
Wait, so who pays?
You do, personally. Your business income gets added to your personal income and taxed using progressive tax rates.
So if I earn more, I just move into higher tax brackets?
Exactly. That's why your total income matters more than just your business income.
So how does that actually show up on my tax return?
Simple flow. Revenue minus expenses gives you profit. That profit goes directly into your personal tax return.
That sounds straightforward. Anything else?
Yes, CPP. As a self-employed person, you pay both employer and employee portions.
Double payment? That hurts.
It does, especially at tax time. Your total tax equal federal plus provincial plus CPP.
What if I start a business with a friend?
Then you're in a partnership. The partnership itself doesn't pay tax.
So again, we pay personally?
Exactly. But only your share. If you own 50%, you report 50% of the income.
So ownership percentage is everything here?
Yes, and mistakes in that split can cause serious issues.
At what point should I think about incorporating?
When your income grows or you want flexibility, corporations introduce two layers of tax.
2 layers?
Corporate tax first, then personal tax when you take money out.
So I still pay personally?
Yes, but only when you withdraw money. That's where strategy comes in.
I've heard corporations have lower tax rates. Is that true?
Yes, thanks to the small business deduction. It reduces tax to around 12%.
That sounds amazing. Is it unlimited?
No, only on the first $5 lakh of active business income.
What about investments?
Those are taxed heavily, around 50% or more.
So how do I take money out of my corporation?
One way is salary. It's a deductible expense for the corporation.
Meaning?
It can reduce corporate tax to zero, but you'll pay personal tax.
So I'm not saving tax, just shifting it.
Exactly, and you'll also pay CPP.
What about dividends?
Dividends come from after-tax profits, not deductible.
So corporation pays tax first.
Yes, then you receive dividends and pay personal tax, but get a dividend tax credit.
So no double taxation?
That's the idea. It's called integration.
Let's go back to CPP. How does it work if I'm self-employed?
You pay both portions, employer and employee.
And when do I pay it?
At tax filing, it's calculated on your net income.
So I need to plan cash ahead of time?
Absolutely, many beginners get surprised here.
What if I incorporate and take salary?
Then CPP is split. You pay half, your corporation pays half.
So I save money?
No, total CPP is the same. Only the structure changes.
So what's the smartest option?
Depends on your goals. Proprietor equal full CPP, salary equal split, dividends equal none.
No CPP sounds good.
Short term, yes. But CPP gives retirement benefits.
Can I pay my family to save tax?
Yes, but only if they actually work in the business.
So I can't just pay my wife randomly?
No. Salary must be reasonable based on actual work.
What about paying dividends to family?
That's where TOSI rules come in.
TOSI?
Tax on split income. If rules aren't met, income is taxed at the highest rate.
So no benefit?
Exactly, unless they qualify under strict conditions.
I've heard about tax-free dividends. Is that real?
Not exactly. It's tax reduced, not tax free.
How does that work?
Through basic personal amount and dividend tax credits, mainly at low income levels.
Are there other ways to take money out?
Yes, benefits. But you need to be careful.
Why?
Employee benefits can be tax efficient, but shareholder benefits are taxable.
What's the biggest mistake people make?
Using corporate money for personal benefit.
Like what?
Paying personal expenses through the company. That triggers Section 15.
So I can't use company money for personal stuff?
No, it's not deductible and becomes taxable income to you.
That's a big mistake then.
Very common and very costly.
What if I borrow money from my company?
You can, but you must repay within strict timelines.
And if I don't?
It becomes taxable income.
I'm still confused about benefits.
Simple rule. Employee benefit equal work-related, shareholder benefit equal personal.
And tax treatment?
Employee benefits are often better. Shareholder benefits are usually fully taxable.
If I skip CPP using dividends, what's my alternatives?
Many use TFSA, tax-free growth and withdrawals.
So TFSA replaces CPP?
Not exactly. CPP is guaranteed, TFSA is flexible. Their strategy often uses both.
This is a lot. What should I focus on?
Understand the flow, not just rules.
Meaning?
Always consider total income, business structure, timing of tax, long-term goals.
So no copy-paste strategies?
Exactly. Tax planning is customized, not one size fits all.